Paul Gruenwald joins us, Global Chief Economist at S&P Global Ratings. Paul, it's good to have you back. Let's pick up where we just left off on the charts here. We looked at the S&Ps, the rally, a reflection of a soft landing narrative, which, as you put it, remains valid as labor markets remain tight and consumer spending on services remains robust.
Yeah, hi, Tom. It's good to be back on the show. You're right. The macro is kind of playing out as we've been expecting. We're sort of softening on the demand side. Looks like the labor market's softening a bit. But let's remember the U.S. economy needs to slow to get on a sustainable path. We're going to get the Q2 GDP in a couple of weeks. But it looks right now that this kind of soft landing narrative is very much in place, looking at the short-term indicators, looking at the labor market. And, kind of so far, so good.
As I'm taking a look here and preparing for Fed Chair Jerome Powell today, I would imagine Powell, expectations are he'll stick to the script, right, in terms of needing more data. But I'd imagine he's also going to talk about how we're making progress on inflation.
Yeah, we've been making progress for a while, right? It's just been kind of uneven in the first couple of months of this year. We were going sideways, if not a bit up. But the last couple of data points are looking more promising. We've seen the forward pricing for the first Fed funds cut move from December to September. I don't think the Fed's quite there yet. We ourselves are still at December. But if we get a couple of more strong prints, then that's probably going to move the needle. But again, we're probably going to need, a few more months of inflation data, a few more months of short-term indicators, and then we'll be more comfortable with that call.
Paul, talk to us a little bit about the Eurozone, what we're seeing there as we gear up for the ECB. I think it's July 18th, right? So next week, Thursday, if I'm correct. In your notes here, right, it looks like you took note of labor market conditions in Europe also tight versus kind of reminded of our neighbors to the north, Canada. They've seen a little bit of weakening there, but Europe seems to be a similar pattern in terms of what we're seeing here.
Right. Well, both the Bank of Canada and the ECB cut rates last month, as we know, both 25 basis points. Europe's kind of playing out the way we expected most regions and countries to play out when we started this hiking cycle a couple of years ago, right? You get this very sharp increase in rates. The rate-sensitive sectors, such as manufacturing, kind of weaken. Europe's gone through a borderline recession on manufacturing with a strong overall labor market. Now they're starting to come out of it slowly. But Christine Lagarde and her team have been pretty clear. They're going to be patient with the rate cuts. We think it's going to be roughly one per quarter, so they're probably not going to move this time. But, once every 3 months, and they'll take the rate from a starting point of 4 down to about 2.5. So they should get to their so-called landing point late next year. But again, should be kind of gradual, supported by a strong labor market.
Yeah, a lot of pressure on Powell, Lagarde for that matter as well, right? Both of them definitely in the spotlight here as they try and finesse and maneuver this soft landing. Let's talk a little bit about China. The economy continues to be weighed down, right, by the property sector and also weak consumer confidence.
Yeah, I was there at a conference a couple of weeks ago and listened to the Premier Li Qiang speak. And yeah, the property sector is still a challenge, and that's got some important feedback loops to the economy. It's not just that property itself is between a quarter and a third of GDP. Land sales are a big revenue item for the local governments, and then households' balance sheets are very heavy on property. So the authorities are trying to balance completing the housing so people have some place to live, but at the same time trying to, inject some discipline into that sector where there's been a little bit too much exuberance. I think the good news for China is outside of the property sector, they seem to be doing pretty well on the macro front, but that's going to be a break on growth. So we've got, China kind of 4.8 this year, and that's a multi-year challenge. We'll have to see if these recent measures around lowering interest rates and allowing people to buy, property in a different province from where they live, that's going to be enough. We're still not totally convinced, but we'll have to watch and see if we get some more forceful measures from the government there. But kind of sub 5% growth for China next year or so.
Kind of a quiet overnight session for China. I think that's all going to end with CPI, PPI this week, I guess tomorrow. We're going to talk a little bit later on in the show about the PBOC not buying gold for the second consecutive month in a row, according to the World Gold Council in June. Talk to me a little bit, Paul, about, again, kind of sticking with this Asia-Pacific theme. It's not just U.S. stocks to new all-time highs, right? I mentioned at the top of the show, you got the Nikkei 225 posting a record historic level as well. Is that more a reflection of the weak yen?
Yeah, we're not sort of equity guys, so we haven't spent a lot of time looking at that, but that sounds pretty plausible. The weak yen is basically helping Japan on balance. There's a tourism boom, there's an export challenge, but let's remember Japan's got lots of foreign direct investment all over the world, and that's kind of denominated in dollars. So that's raising their gross national income, even though their GDP's kind of soft. So that's not too surprising. But yeah, we're seeing a little bit of a recovery in the electronics export cycle, so that's helping Japan as well. So we still think the pieces are in place for the Bank of Japan to kind of very slowly dial back the asset purchases and raise rates, but they're in a completely different cycle from the other central banks we just discussed. But Northeast Asia with the electronics uptick around Gen AI and data centers and that stuff looks like it's a pretty strong story right now.
Yeah, just kind of again along those lines with rates at these levels, and per your notes, higher real and nominal rates are going to benefit savers. Right. You talk about how they're going to reduce the potential risky search for yield and provide more space to policymakers to deal with the inevitable shocks that lie ahead.
Yeah, well, the thing to watch, well, we've already talked about the soft landing scenario and the rate cuts coming gradually, but where are we going to land, right? So when we're back to neutral and, everything's kind of cool and we're on the golden path, whatever, the Fed, we think, is probably going to be just under 3%, ECB 2.5%. So those rates have come up. Those are higher than what they were going into COVID in 2019, and the so-called real interest rates higher. So that's going to redistribute purchasing power from borrowers to savers, and that's being boosted by high fiscal debt, but it's also being boosted by this kind of investment boom around the green transition. So we think we're in structurally a higher rate world, not a super higher rate world, but that's going to be different from what we've gone through in the last decade or so.
Yeah, more kind of normalized higher rate world in some ways.
Looking more normal for us older guys, right? The last 10 years were a bit of an anomaly. That's right.
That's right. I mean, not everybody's familiar with zero rate interest loans, right? That was a bit of an anomaly in many ways, that very long period of time.
Right,
so,
and it's we're going back to where we were before the GFC is actually healthy in our view, right? I think that low interest rate period has some distortions that probably are better to put behind us.
Solid breakdown, Paul. Appreciate you joining us here and sharing your thoughts. Paul Gruenwald, Global Chief Economist at S&P. Good to have you at S&P Global Ratings.